Hi, good morning. Good afternoon, everybody. Ilyas, Rajiv, Suk, TM. Hope you're doing well. Okay, folks, just going to give folks 30 seconds. Hey, good morning, Suk. Hey, Rajiv. It's interesting morning this morning, so I'm looking forward to running through things. These are very tricky market environments to be trading in, so I'm just going to show you how my strategy for it. Okay, so remember the purpose of this session. What's the macro fundamental bias? What's the sentiment? What's the clear macro fundamental opportunity that we have, if any, today? We do have a clear fundamental opportunity today. However, what we have to be aware of is the incredible sensitivity to headlines regarding energy prices. So let's just summarize what the main issue is in financial markets. And essentially, the main issue we've got is there's been a big geopolitical shock. And that geopolitical shock is obviously the US-Iran conflict and the impact on energy markets and that knock-on effect to inflation and central banks' monetary policy. That's the main issue. So we've seen WTI, Brent crude surge, up percent, another 5%, 1%, so up sort of 12% in a few days. So just ripping energy markets has led to this phenomena, which is a big sell-off in US treasuries and bond markets around the world. What investors are seeing is they're saying, oh, hang on, if energy prices are going to be maintained at this high level, that's going to put price pressures into the supply chain. That means consumers are going to end up paying higher prices. We're back to inflation. All those central bank interest rate cuts that we've been expecting, they are now being questioned. That's what's been worrying markets in the main. So when we look at equity markets, we saw European markets selling off heavily because Europe is a net energy importer, and we've seen European markets sell off because of that inflation risk. In the US, we saw sell off on the inflation risk, but that dip has been bought partly because the US is a net energy exporter and produces more oil than anywhere else in the world, even more than Saudi Arabia, if you can believe that, because of its shale and fracking and its technology. And that has meant that we've been able to see a bounce in US equity markets. So what that now means is that markets are hypersensitive to what goes on in the oil market. The oil market is hypersensitive to what's going on in the Straits of Hormuz. Now, if you look at our calendar today, you'll see, right, headline after headline about these straits, right? Iranian cap not closing the Strait of Hormuz. Iran is currently handling ships. Yesterday, apparently, Iran said only Chinese vessels will be allowed to pass through. So there's a series of headlines about what's going on. And the big issue is this. If the Straits of Hormuz can be taken over by the US and it's allowed for normal progress, then that's going to allow risk to recover a little bit because it means oil can get to market. And if oil can get to market, then that sort of high inflation, oil driven risk off food can fade. Right. But what's going to happen? From my reading around, the basic view is that Iran's sort of bedding down for a longer conflict, and there's no easy way of opening that Straits of Hormuz quickly. And you can see that although energy prices are off their highest levels, right, they're still very elevated. But crucially, they're not just going up and up and up and up. They are being capped for now. So it is two-way. And if you look at this headline has lifted sentiment this morning after the main news. Iran prepared to get rid of Iranian stockpiles in US talks for something good, apparently, right? However, that report suggested this proposal was made during the pre-war US-Iran talks. So that kind of offsets it a little bit. But that's positive. It's saying that Iran's wanting to negotiate, wanting to get rid of their stockpiled uranium, all positive for a resolution. What this all means is it's very, very sensitive with risk. And it means risk can change with a headline. So what that means, and this is the most important takeaway, is don't have like positions with wide stops on a day like this. Right? This is when we need to be technical, clever, minimal stops, looking for strategic entries. Okay, so that's the point one. One headline can send markets soaring or plunging. And it's linked to war. And there's a reason why insurers often will not insure in a war, because it's so unpredictable. It's the fog of war. And we've got that literally played out in Technicolor for us, because we've got the live squawk with breaking global news happening, at literally the click of a button. And we're getting the latest data and the latest news. So trying to trade each of those headlines is probably a bit of a mug's game. And what we need to look at is probabilities. So as it stands, a probability is there's not going to be a swift resolution in the Middle East. So as a result, that should keep the dollar bid. That's my working thesis. There was also a report from ING, and this is a bit more left field, that the US private credit space is starting to come under pressure because some companies which have been directing high net worth retail investors towards software companies, there's a worry that some of those investors have been fueling the artificial intelligence race, and they're starting to pull back on some of their investments. So that is part of that tech scarce trade. So don't forget, the two major risks we've got to markets is one, energy driven, right? And number two, the tech scare. And that will be expressed in the NASDAQ. Volatility is off its lowest levels. And if you look at this here, you remember looking at this, that bullish piercing line pattern. That is now a bullish piercing line pattern. So that remains a dip buying opportunity technically. So, is the S&P 500 going to necessarily surge higher? Hard to see. Look at the Dow Jones. You can see this is consolidation. This is a technical area.
Just on the energy front, and also for European relations. So reports that the EU is said to be considering aid in order to fix the Ukraine oil facility. That's at the centre of the loan delay. So again, that would be in relation to the facility that's holding up flows through Druzhba and has prompted the opposite.
So we're going to be dealing with a flurry of energy headlines all day, right? And remember, even sophisticated algorithms will end up being turned off when there's too many headlines. We had it with the UK and Brexit. There were so many Brexit headlines that they had to turn the algorithms off. We're in a kind of a similar kind of environment. There might be one headline that's a great one to jump into, but there'll be lots of noise in a day like this. You can see European stocks are trying to put in a base. Volatility is lower. There's an attempt at a bottom here. You can see there's an attempt at a top in WTI. And that's kind of the big driver. So looking at the daily European news, right? The data is really sitting in second fiddle for today. We've got jobless claims, but really it's not going to be very important compared to the geopolitical risk that we've got. We had that strong ISM print yesterday. In other words, the US is booming. GDP is looking positive, 3% on target according to the ISM. And that's all positive for stocks. So there's nothing to worry about there. One jobs data isn't going to make much difference either way. The FX space, the only trade idea that I can see on a day like this is the dollar. And it's to buy the dollar at appropriate levels. So for me, what I'm looking for here is euro dollar, and there's two regions, right, of selling. So the first area I'm looking at is here, the 115, the 1.1650, right? 5-point stop, try up to 3 times. Then if we get above that, the 1.1672. There's two areas there. There's also another area, which is here. And what I'm looking, if you notice this pattern, we've got this, you see this kind of, and if you look at that, you see really, you see we've seen that. Let's see if you just pull this down. So what we're looking at here is any retest of that challenge, of that channel. And you could argue that there's been a bit of a retest up there. Okay. However, if you're looking at it, it's dropping. We've got this big support area. So part of me wants to say there would be another opportunity if you go through here, but it'd be a tight one breaking down through that trend line, looking like for the 520. Let's just have a look at implied volatility levels to see what we've got. Right, 3-1. You've got implied volatility at 5, so that would be the target. So I could see the possibility of a break from there going down to the 531 if we break down through this level. Now that's based on the narrative that the dollar strength, that the Straits of Hormuz is not going to quickly be freed up. So that should keep the dollar bid. So on pullbacks, reasonable to sell from the 650 and the 672. On breakouts, looking for a breakout from that level, potential retracement down there. Right, so they're my two outlooks. That is all I see today. I think everything else without a tiny stop is just too risky, because you could be caught the wrong side of the market on a day like this, with just one headline breaking, and then it automatically, it fades instantly. So the sentiment for today remains dollar positive. There'll be flushes of risk off, but there'll be pockets of risk on, depending on the headlines. If you take a look at the futures market, we can see.
Entry from ECB's Nagel says, in the scenario that the Middle East conflict with end, the consequences for inflation would be short term and it.
I mean, that's from the ECB. That's pretty much the narrative. If this is just if this conflict ends, and Donald Trump, he could end it, later this afternoon, couldn't he? Do you know what I mean? If he wants to see stocks rally, right, he can just say that. But if you look at the moment, seeing oil prices higher at the moment, equity markets lower, the dollar stronger, net energy importers like the euro and the yen weaker, gold is sort of stuck in the middle, and we're seeing a little bit of a sell-off in the bond market. So that risk-off theme is coming back in, right? Dollar strengthening, oil is rising, stocks are pressured, bonds are selling off. So that's my set. Now you might take a different view and say, oh, this is all going to blow over. It's the taco trade. Trump always chickens out by the dip. There's too many headline risks in an environment like that to take that position. But if you did take it, just make sure you've really you've limited your stop and your clearly where your risk is. So this is it's the euro dollar strength 672 651 breakout. So there's either way. Remember yesterday, and we were looking at the 672 only, and we saw that the dollar just kind of did nothing, and then we had the ISM and the dollar did nothing. The market doesn't know what to do. It doesn't quite know what to do. Is this a longer term problem or is it not? So I'm reading it as heightened uncertainty. We've got non-farm payrolls coming up tomorrow, and there's a question mark as to how much movement that's going to give markets with this geopolitical risk. So we're now in a bit of a lull. It's almost like the eye of the storm feel, and we're just waiting for that next, catalyst driver to come in. Yeah, TM. Right, and normally that would have been. We saw a little bit of a move higher in the ES, and that boosted sentiment a little bit in the futures market with our trading yesterday. This is what we were expecting. That made sense. But the dollar's reaction was nothing. I was looking over, someone in the room pointed out the dollar. It may have even been Najam, and he was sort of saying like dollar's flat. And I looked over and I was like, dollar was just flat. And I was looking to enter in dollar strength at the 670. Looking over, are we getting near? No, it was Jay. Yeah, thanks, Najam. We were noticing that. So that just means data is less important right now. The market is laser focused on energy, the Straits of Hormuz, difficult trading environment. It's kind of a better environment to like stay out. Do not have long positions. If you do have big positions in wide stops, make sure you understand the risks fully and you've committed to that loss as well. You can make money. We had that 37-1 risk reward, didn't we? That lovely trade. 36, 37-1 on the dollar strength. Right. There's a potential for something similar today, but keep the stops minimal. All right, folks, and obviously watch out for Straits of Hormuz. The no-brainer. If the Straits of Hormuz, if the conflict ends, buy the euro dollar. Buy the euro dollar. That euro pound trades back on. That's the no-brainer. That's the no-brainer trade. And equity markets, if you can get into them. Okay, folks, that's all for now, and I will look forward to seeing you tomorrow. We'll get ready for non-farm payrolls tomorrow. It's good practice for us to get ready for it. But it will come with caveats tomorrow because of the energy crisis. Okay, folks, enjoy the rest of your session. Yeah, thanks, TM, and you. Don't forget these levels here for today in the euro dollar. There are opportunities, but they're limited. Take care. Cheers, Rajiv. Bye for now.